Are you looking to buy a home? Do you ever think about refinancing your home? In the process, have you struggled with what amount you should use as a down payment? Are you putting your money to work for you? For many Americans, their home is the most significant asset they will ever own. When buying a home, the down payment amount is a huge decision. This decision can have a substantial impact on your future profits. Let's take a look at a few items to consider. 1. Is this your forever home? On average, first-time buyers in the United States stay in their home for just over 11 years. On average, individuals that have previously owned a home will remain in their current home for approximately 15 years. 2. Are you buying as an investment property? With any investment, the goal is to typically maximize your future return while minimizing the potential for risk. Whether purchasing a property as a home or investment, a minimum down payment is standard. Still, often purchasers decide to make a down payment that is larger than the minimum requirement. So just what is the optimal down payment to maximize your potential return? Consider the following scenario where you purchase a property for $300,000 and the required down payment is 20%. You decide to put down more than required and make a 50% down payment, which totals $150,000. Or you choose to make the minimum required down payment of 20%, which totals $60,000. Fast forward 10 years and assume the property is worth $600,000. Which option generated more profit? The larger down payment of $150,000 has made you $450,000 for a profit of 200%. But the minimum payment of $60,000 has earned you $360,000 for a profit of 600%. By choosing to put down a minimum of 20%, you have increased your profit by 400% versus putting down more than required. But there is more. How could you have made that $90,000 work for you over those 10 years? Let's look at an example. Instead of making the larger down payment, you put that same $90,000 into an investment portfolio that averages 8% growth annually. What is the outcome? Your $90,000 has now grown to $199,767 over the same 10-year span. That is in addition to the $360,000 profit you made on the house. If you stand to make more interest on an investment or debt avoidance than your mortgage interest rate, you can use your cash to come out ahead.